Risk management in trading. Safeguard your investments. However, there is no assurance that one will be successful when it comes to trading. Because of the volatile nature of the markets, there will always be risks involved with any particular transaction. However, if you implement efficient risk management tactics, you will be able to reduce the consequences of any potential losses and increase your profits. Hello everyone, and welcome to a brand new video on the channel. Today, we are going to talk about risk management in trading. Safeguard your investments. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Understanding risk. Prior to delving into risk management measures, it is essential to have a comprehensive comprehension of the meaning of risk in the context of trading. The term risk refers to the possibility of incurring a monetary loss, which is inherent in any activity that involves trading or investing. Every trade you make gives you the opportunity to make a profit, as well as the risk of losing money. In order to safeguard your financial resources, the objective of risk management is to recognize, evaluate, and eliminate any threats. Identifying risks. An effective risk management strategy begins with the identification of the potential hazards that are linked to the trading activity that you engage in. Market volatility, economic factors, geopolitical events, and even operational risks such as technological failures or human errors are examples of the types of risks that might be included in this category. By gaining an understanding of the numerous hazards that you can encounter, you will be able to design a complete plan for risk management. Assessing risks. Following the identification of the potential risks, the subsequent stage is to evaluate the possibility of each risk, as well as the impact it could have. In order to determine the potential repercussions of each risk, this requires conducting an analysis of historical data, patterns in the market, and any other pertinent information found. You are able to prioritize the risks and distribute your resources in accordance with the results of an objective evaluation of the hazards. Key risk management strategies. Now that we have a strong knowledge of risk management, let's investigate some key tactics that you may use to protect your investments while trading. Number 1. Diversification. The practice of diversifying your investments is a tried and true method for mitigating risk. The concept of diversification refers to the practice of distributing one's capital over a variety of asset classes, industries, and geographical regions. You will lessen the impact that any one investment has on your whole portfolio if you choose this course of action. The benefits of diversification include the reduction of the danger of experiencing concentrated losses and the provision of a safety net against fluctuations in the market. Number 2. Stop losing orders. In the world of trading, stop-loss orders are crucial instruments for risk management. It is an instruction to sell an asset when it hits a particular price level, and this is what is known as a stop-loss order. You can restrict the amount of money you could lose by establishing a stop-loss order, which will cause a trade to be immediately closed off if the market goes in the opposite direction. Stop-loss orders provide you with the ability to have predetermined exit points, which helps to ensure that you do not let your emotions influence the decisions you make when trading. Number 3. Position sizing. The term position sizing refers to the process of establishing the level of capital that should be allocated to each individual trade. You are able to exert more control over the amount of risk that you expose yourself to by utilizing this crucial risk management method. If you determine the size of your positions based on your risk tolerance and the potential loss you are willing to tolerate, you will be able to preserve your capital and avoid excessive exposure to risk. Number 4. Risk-reward ratio. In the field of risk management, one of the most important concepts is the risk-reward ratio. In this way, the possible benefit of a trade is weighed against the probable loss of the move. You can ensure that the possible benefit is greater than the potential risk by ensuring that the risk-reward ratio remains positive. It is usual practice to utilize the ratio 1:2, which states that the goal is to produce twice as much profit as the potential loss. You are able to increase the amount of money you win from your winning transactions and reduce the impact of your losing deals by utilizing this method. Number 5. Regular analysis and review. It is necessary to do regular analysis and reviews of your trading actions in order to effectively manage risk, which is a continual process. Through the process of examining your transactions and analyzing the results, you will be able to recognize patterns, evaluate the efficiency of your risk management measures, and make any required adjustments to enhance the performance of your portfolio. Analyzing and reviewing data on a regular basis enables you to maintain a proactive stance and adjust to shifting market conditions. Trading is not without its hazards, but if you develop and implement appropriate risk management measures, you can protect your money and reduce the likelihood of incurring losses. Protecting your cash and increasing your chances of success in the trading market may be accomplished by the identification and evaluation of risks, the diversification of your portfolio, the utilization of stop-loss orders, the management of position sizes, the maintenance of a good risk-reward ratio, and the routine analysis and review of your trades. You should always keep in mind that risk management needs to be an essential component of your trading plan, as this will enable you to navigate the markets with confidence. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.